Hey, hello folks. Welcome to Pro Trader Strategies. My name's Eric Wilkinson, and this is Spotting the Trade for Thursday, September the 30th. Hey, what I like to do in these videos is talk about the economic data, see how that impacts the overall markets with some market analysis, and then talk about some trades that I'm doing. So throughout this video, if you find something that lights that light bulb up in your head, please smash that like button for me so you can share that information with somebody else out there. Because literally when you're hitting that like button, it feeds these little robots that runs out there and finds somebody like you. Also, if you want me to talk about something throughout this video, throw it over there in the comments section. Maybe you catch me misspeaking. I am known to do that. So catch me or throw something out there so we can chat about it. All right. And finally, subscribe. There's a little bell at the side there that'll give you a notification when I pop in unannounced. Usually when I'm popping in unannounced, that's because I found an opportunity in the market. So I want to make sure that you guys are in on that. So make sure you guys had that little bell lit up as well. All right, so let's go across the pond and talk about actually in Asia last night, really Wednesday night for most of us, we got the Chinese PMI. Remember, Purchasing Managers Index, forward-looking kind of aspect here. Well, we're back to China talking about PMI numbers, and I usually don't really like to look at Chinese economic data points because I have a feeling that they don't always tell the truth. And that's usually because they're inflating them. But what we're seeing here with the manufacturing PMI comes in 49.6. Anything with these PMI numbers below 50 is contraction in the economy, folks. It was expected to be 50. It's still, last month we had a 50 reading. We went below 50 right now for the first time since basically the pandemic, folks. So we're seeing contraction in Japan. That's the purchasing managers. They're the manufacturers of the goods that everybody across the globe is buying. If they're the first line of defense, seeing what demand is, and they're pulling back on their outlook, that is not necessarily good. That's the real first sign of weakness in the economy, global economies right now, going below 50 there for Chinese manufacturing PMI. All right. And then here in the United States, across the pond, we got some CPI numbers pretty much in line. But I want to fast forward here to the United States because we got our economic data in the form of GDP. That came in at 6.7%. Now, we've been talking about transitory inflation going on. Well, something to note in this GDP number that really caused the weakness. It wasn't the fact that GDP upticked a little bit. It was the fact that we are seeing the PCE number. Now, remember, when we're talking about inflationary numbers going all the way down the ratchet list here from the manufacturers producing a product that they have to pay higher prices for. Now, if they can send that down to the personal consumption expenditures, which is all the way down past the broader public there, coming down to you and I, if they are able to pass those prices on all the way down to the retail investor or the retail person or the consumer that doesn't really use this product as a business or for their business, that's what we're trying to talk about there. And if they can pass those all the way down to you and I, that no longer becomes transitory, because even if prices come off and that company has been able to offset higher prices to you and I, they are going to lower those prices for us, folks. What they're going to do is they're going to increase their margins on their products, okay? So that is where we see the transitory nature of inflation out the window, when they can pass it all the way down to the consumer in the PCE. And that was showing up here in the GDP. We're going to get our other PCE next week, I think it is, where we'll see a more real time, I guess is the word I'm looking for. Not really, but a closer data point. This one was from the last one, just a revision showing up in the PCE, all right, personal consumption expenditures. There we go. Got all that out of the way. Another one that we got was the Chicago PMI Purchasing Managers Index, forward looking, seeing how the economy is doing. That came in line slightly below expectations there. And then we also have a bunch of Fed governors talking today for the rest of the day. All right, so let's get on with the overall markets. Remember to share my screen here, and there we go. All right, so we've got crude oil here. I've been talking about crude oil. I think there's really a lack of demand here. If we start seeing China's PMI numbers start to drop on the manufacturing sector, keep in mind that is a high driver of crude oil, not because of the gasoline, folks. It's because of the byproducts that come out of that. It's called the distillates, and some of the distillates is polypropylene, which creates some of the plastics. All right, so that is going to be a driver of demand for crude oil. While we're seeing a lack of demand through these manufacturing numbers here in the United States and especially in China, that should cause a little bit of weakness here in crude oil. So I am sharing my screen. All right, bonds stuck right here on the value area low. There is a point of control slightly below us here at 157. Are we going to creep down there? I'm expecting us to move back into the 60s because I don't think that we're going to get the employment mandate for the Fed to raise interest rates. Yeah, we're going to see a little bit of inflation, and that's going to drive folks to say, hey, you got to raise interest rates. But if we aren't at that employment mandate, it's going to put them in a corner here. So I don't think bonds are going to go much lower, meaning interest rates are going to climb. I don't think they're going to go much lower than where we are right now, maybe a little bit, but I am expecting upward pressures, especially if we're seeing the economy slow down. We'll see a pullback in the equities. That should drive bonds higher. Gold starting to make a move back towards that 1800 that I've been talking about. I am short puts in GDXJ, the miners for gold, because we had a volatility spike in there. And I was more than happy to get gold at a level when markets coming off in gold, when we're seeing these inflationary pressures across the board, whether or not they're transitory or not, doesn't really matter. If you're seeing inflation, it should drive gold higher. And finally, we got the snap here as folks are seeing that this inflationary pressures are being pushed off and offset all the way down to the consumer. All right, you and I, that is something that we know is no longer transitory at that point. Giving Bitcoin a bit of a boost as well. Anything, I think, anymore, gold and Bitcoin are going to be pretty much in lockstep with one another. Maybe not, percentage term moves, but I do believe they are going to start following each other a little bit more closely. All right, VIX is continuing to move higher here throughout the day, and that is because we are seeing weakness in the equities throughout the day. Overnight, we started out pretty decent. We got that Chinese economic data. We started really coming off a little bit. And then we're starting to see some of that follow through here in the United States. One thing I forgot to mention was the jobless claims increasing a little bit to 362,000. It's supposed to be 333. So another 30,000 jobless claims. We're just not getting that employment move. I mean, people, our school district is looking for bus drivers, begging for people to drive the buses, okay? And they can't even get all the kids to schools. After school programs, they're not sending kids home on school buses on those after school programs. This is a major problem, all the way down to busing, having problems with hiring. So NASDAQ, we're going to keep an eye on this. Yesterday, look at this. If we pull this, stretch this out a little bit, this is a bottoming pattern, folks, and we nailed it right on the Fibonacci, this golden Fibonacci that I have set up here. Now, I've talked about reversal of momentums. This type of candle on a support level like that is a strong bottoming pattern, okay? We haven't gotten it confirmed yet. As a matter of fact, we've got a spinning top doji, and right now, you can see it's hard to tell with that. I was going to try and give you a good representation of this is what a tombstone doji looks like, and bottom top moves. That's really something we're going to be looking for as well. These type of candles, all of these are topping patterns really, but a bottoming pattern nonetheless here. Now, to confirm this, we would need a settlement above yesterday's wick. So somewhere, let's just call it above 14,920. A settlement above that would really make this a confirmation. Now, if we settled down below yesterday's wick on the downside, let's call it 14,720 to the downside, well, that is confirmation of a move to the downside. So keep your eyes on this today. This is going to be key for going into tomorrow and next week for the most part, to give us a bit of a feeling as to the directionality of this. I think that we have pretty much set up this head and shoulders pattern, and for that measured move, I would expect us to at least come down and tag the next Fibonacci line. That's about the measured move to the downside. That's below this trend channel and the 200-day simple moving average. So those are two targets that I would be looking for in equities for the NASDAQ. Risk to the downside, NASDAQ. Risk in the E-mini S&Ps, Dow Jones, again, to the downside. I think that there is some headwinds for the economy, especially now that we've seen that PMI number out of China. That is going to be a forward-looking data point. Purchasing managers is about as forward-looking guidance as you can get. And we saw that pull back below 50, which means contraction. That is not good for a global economy. And I think the equities are starting to realize that. You can see here overnight, this was right around when we got that Chinese data, a little bit of weakness in there. Kind of brushed it off a little bit as the overnight started pushing higher, but we got long, and coming into the day, right here is where the market started breaking down. That was right around the time the European markets were starting to open up, and we started getting a little bit more weakness throughout that. And then I think we're going to continue to see weakness throughout this day as testimony and everything else. There's just nothing I can see coming out right now that is going to give us a boost to the upside. Facebook. If you are long Facebook, I would be looking at doing some covered calls on this. Stay mechanical, lower your overall cost basis on it. They have some headwinds going on right now. People are starting to compare them to cigarette companies because they are addictive in nature, and they are not health conscious, if you will, because of the fact that children are using their products, and 1 in 3 have body related issues. So all of these things, they're hiding some of the negative effects of their product. And I think that that is kind of causing a little bit of a problem, especially with government seeing all of this go on. So Facebook really having some headwinds right now. I don't know. I don't have a position in here, but if I had a position, if I was long Facebook, I would absolutely, in this type of environment, be looking at covered calls. Maybe not right around their earnings, but for the broader, longer duration, covered calls in Facebook is something I would be very keen on. All right, FedEx. A lot of news in and around FedEx. We'll talk about that in more detail today when I have a lot more time to talk about it. We're going to be looking at this for a trade on the butterflies. And I'm going to talk about the butterflies because they're a little bit of a different beast in regards to a long call butterfly or a short call butterfly. It doesn't necessarily fit the thesis that we always talk about, in that, you know, you want high volatility for a short call butterfly. That doesn't necessarily go hand in hand. Short and butterfly, there's a bit of a disconnect, and I'll talk about why that is. It's kind of like it goes from a caterpillar into a butterfly or whatever, but we'll talk about how the butterfly differs in the wording that we talk about and what we want to happen. All right. So we'll talk about that in the video today, and I'm going to use FedEx as an example on a pop or drop. What do you guys think is going to happen with FedEx? Is it going to jump up to cover this gap, or are we going to be looking at something like when we are at a point of control that is quite a bit lower than where we are now on a 3-year chart? So keep in mind, this is the kind of market action we were seeing pre-pandemic, right? So is FedEx going to go back to the pre-pandemic levels? Well, that is what I'm trying to come up with my pop or drop. Are we going to drop and go back to pre-pandemic levels, or are we going to pop in order to try and cover that little mini gap from the year chart that we have here? So a bit of a gap to the upside, pressure to the upside with value area being so far above where we are. That could really drive this market higher, or are we going to revert back to pre-pandemic levels? I don't really know. I don't care. I know a trade that will set us up for success around either one of those scenarios. So if I get the pop or the drop, I can benefit from it, and I'll talk about how you can implement this strategy around this underlying and follow the guidelines that I'm going to set forth for you guys. I'm going to talk about how much the risk reward should be. What's your ratio on your risk reward? All right. Not every spread is $5 wide or $10 wide, but I'm going to come up with a ratio for you guys to follow through as a guideline to make you guys a little bit more successful. All right. Stay mechanical. Take that emotion out of it. That's what I'm trying to do here is if you're thinking about trading and correlating that to money rather than probabilities, you need a little work to do. Okay. We need to get to a point where we are thinking about probabilities and taking the emotion out of trading. And when you're correlating it to money, that is an emotional aspect. All right. So if you've taken anything away from this, please comment, smash that like button, send that bot out there to find somebody else just like you that can participate in this, and subscribe. I pop in here unannounced every once in a while, folks. So if you have that little bell lit up, you will know when I'm popping in here talking about a trade. For instance, if I find a trade in the next hour, I'll probably pop on here and talk about it if I'm going to put that into my portfolio. All right. So that's all I got for you. If you can't take that, take it easy.